Welcome to the Investing Show, where we discuss ideas to help you make more of your money. I'm Simon Lambert of This Is Money, and I'm joined today by Stephen Yu, the manager of the Blue Whale Growth Fund. Stephen, welcome back to the show. So we had a slightly small political event this week, the second election of Donald Trump to the US presidency. There's been a lot of talk about how this potentially shifts the goalposts for investors as well as politically. But before we move on to that, and also how you're investing at the moment, first of all, you're a global manager. The US is only one country. Why does this matter so much to investors? What happens over there?
So we consider ourselves as bottom-up stock pickers. We only invest into about 25 companies. At the moment, about 2/3 of those names are American companies. So obviously, if Trump is in office and he's going to do some new policies that's very different to before, I think we need to consider that in terms of the impact on our companies. And I'm sure we'll get into that, for example, like the benefit of him maybe doing something on anti-regulation that could be quite helpful to certain tech companies. And at the same time, if he's going to impose certain trade tariff with other countries, then maybe it's unhelpful to some other domestic manufacturing sectors that are selling overseas. So that's something that you would need to consider as far as American companies are concerned.
And do you see the next 4 years under President Trump as being potentially substantially different to what the next 4 years would have looked like under Kamala Harris?
That could be a very interesting development that we are going to see in the next 4 years. Is probably going to, Trump is going to generate quite a lot of noises as like what he used to do in his first term. And then secondly, I think what is interesting this time round is not only that this is going to be his last term, so you would expect that he would try everything that he can to do some things that he do believe in. And then the other thing which is very interesting this time around, which wasn't the case before, was he got Elon Musk kind of working with him in some capacity, and then you would see that maybe Trump would be less predictable as far as maybe technology companies concerned, just given Elon's involvement on that front.
And he has inherited an economy and a stock market that are in pretty rude health, hasn't he? But there are some problems there. Obviously, inflation has been a key issue in this election. So he's obviously considered to be the more business-friendly of the two. He's certainly considered to be the more tech business-friendly, which is interesting because I seem to remember last time round, he wasn't the biggest fan of tech companies, but now there seems to certainly be this love-in. What are the directions that you expect the kind of Trump presidency to take, and what does that mean for the kind of businesses that you're investing in, those growth companies?
So one thing that's been probably quite clear as far as Trump's mandates is concerned, that he's going to focus a lot on America as a country in terms of making America great again. So there's a lot of policies going to be beneficial to American companies that would probably be more exposed domestically rather than overseas. So what it means is you would expect, like for in particular the tech giants, most of the big tech companies are American companies, and he's probably going to protect the interests of those companies, because theoretically, like he could easily like weaponize some of the technology, like maybe Nvidia GPU. If we're friends, we would probably let you buy a few more of those GPU. If not the case, then maybe they would stop letting you buy it, or maybe they will impose some sort of trade tariff. So I think there's a lot of interesting development going to take place. But the other thing, going back to your question, that you're right, I think previously Trump wasn't a fan of technology companies, but at the same time, I think as we all know, the American politics is all about probably making him look good and making a way for him to win or to try him in the office. So I think there's a lot of pragmatism behind that in terms of his relationship with technology company. I think Elon Musk working with him, in contrast to the last election, is very telling.
And as investors, we're advised to not to chop and change, not to be trying to, either time the market, whether that's with individual stocks or with the market itself. But when a big event like this happens, as a professional investor, does it change your positioning? Have you changed how the fund is positioned in light of this, and were you doing it in the run-up to the election?
So for us, going back to my first point, that we are bottom-up stock pickers. We only pick about 25 companies. But of course, what is really important is when we look at the earnings power of our companies over time, let's say in the next 4 years, then we would need to assess whether politics would come into play to affect those trajectory, right? Like if Trump's policy is going to be a headwind to the earnings power of some of our companies, then I think we need to reassess, because then the valuation numbers, the forecast numbers would no longer be as attractive. On the other hand, like if the policy is going to be a tailwind to some of our companies, then yeah, we might want to scale up some of those opportunities. So running into the election, that we were positioned, I would say, indifferently. Like I think either way, whether it's Harris or Trump, it wouldn't materially impact our portfolio per se, just because they are not correlated in either direction. But of course, I think since the election that we have probably started to see a few winners on the back of Trump taking office, then that is something that we want to reassess. At the same time, I think you made a very important point that from an investor perspective, while we would say, okay, yeah, we are bottom up, we are long term, but what is really important is you need to have your investment in sync with the macro backdrop, which would include politics too, right? So if you just think about like technology company during the during the Democrat era, is all about regulations, antitrust on the big tech companies, right? Like you have Linda Can doing a lot of work trying to break up Alphabet or some other company, and I think under this new era with Trump running it, that's probably going to be the reverse of that. So there's a lot of risk. Previously, that was very important, that maybe you need to reassess whether the valuation makes sense. But going forward, if that risk is no longer here, then maybe you can take a more positive view in terms of the development of those big tech companies.
And I mean, it's been a good year for the fund. It's been a good year for investors in those kind of growth companies that you hold. It's been a good year for investors in the US market. Obviously, it's not a US only fund, as you already explained. What are the stocks that have done particularly well this year for you, and do you see them continuing to do well?
So within the fund, that I think last time when we talked about them was probably early this year, that we have been heavily exposed to artificial intelligence. But I think what has been very interesting within our exposure is the development as far as the space is concerned, that we are very positive on AI infrastructure. So the likes of Nvidia, Broadcom or Vertiv, that will provide the infrastructure to do the generative AI computing. And we have been a lot more cautious on AI applications. So companies that are spending a lot of money investing into the AI GPU in order to develop some sort of software. So the likes of like Microsoft and some others that we have been selling a lot over the last 6 months or so. So that's one area, and of course, within the AI infrastructure, like Nvidia has done very well, Broadcom or Vertiv and some others have done very well too. And the other areas that we have been exposed to, which is very different to that context, was in sports gaming in the US, and through two companies called Flutter, used to be listed in London, now they have reallocated to the US. At the same time, DraftKings. And so if you follow the sports market, in gaming market in the US, is multiple times bigger than the European market or rest of the world. And the states in the US have just started to legalize sports gaming only a few years ago. So if you look at the penetration today, it's only half of the states have legalize them, and if you then try to work out the GDP per capita or how big the potential size of the sports gaming market in the US relative to the rest of the world, is very promising. And this is very independent of the AI development, very independent of the trade tariff, or even whatever Trump is going to do, because this is going to be done on the state level. I think the last stock, which has been very interesting for us too, is Philip Morris. That Philip Morris, if you haven't followed it, they have been the pioneer to take us into a smoke-free world, away from traditional cigarettes. So they got this product called IQOS, I Quit Ordinary Smoking, a machine that would allow for the heat not burn technology. And at the same time, they have acquired Swedish Match, which is a company that would do nicotine pouches and all the others. So, and so if you look at a company, you would think, okay, this is quite traditional company, it's not that exciting. But then if you look at the share price return, it's actually gone up more than 30% this year, which is a lot higher than your Microsoft that you think, okay, Microsoft is going to do well. I mean, Microsoft has only gone up 1/3 of that, which is about 10% year to date. So I think what is important from an investor perspective is you constantly want to look for new ideas. And of course, I mean, we still think Microsoft could do well, but then maybe the valuation is a bit less attractive now, and at the same time, yeah, we're a bit concerned about the AI spending, and there will be other opportunities out there that might be very different, and at the same time, they could do quite well.
And going back to those sports gaming companies, to Flutter and to DraftKings, what was it that made those two stand out?
So in the US, it's a duopoly market, so there's only a two players market so far. I mean, these two companies across different states, across different games, would control over 80% of the market share. And in terms of the market share split between the two companies are quite similar. So you might have in some states 40-60 or maybe 60-40 or 50-50. So basically, as we all know, that once a consumer have decided to go with a certain brand, then you would probably be a bit more loyal. Of course, I mean, ultimately it's about the two players market, just like your Visa, MasterCard, or like a lot of other things like your mobile operating system is whether you use an Android phone or use an Apple phone. And so then once these companies have built up a very sizable presence and position, then they will be able to capture the economics or the potential customers. And at the same time, as I flagged earlier, that because the sports gaming is legalized on a state-by-state basis, so what it means is that 50% of the states who has not yet legalized sports gaming would be probably seeing the adverts maybe in other states when you go to other states, and so by the time maybe the state that you're living in at the time would have legalized the sports gaming, then you would probably got to know about the brand beforehand already. So then there's a lot of synergies in terms of how the marketing is done when they probably advertise on some of this like major sports event, etc. So you'll be seeing this company being quite visible even before you might be able to open an account with them.
And I presume the advantage for a company, you know, for either of them, but also, you know, particularly for a company like Flutter, is that they've already done it over here, kind of thing, and it's, you know, it's not rocket science then replicating that into another country.
That's right. So in particular, I think between the two of them, I mean, we would prefer Flutter on a slightly more, just because the experience they have had, like in the UK, in Europe, in Australia, and there's a lot of know-how, and obviously they're rolling that out into the US sports market. And at the same time, we will probably expect some of this know-how would be feedback of some of the games that's available for the American to take to participate in, could be then also cross-sell back into the markets that's outside of the US. So there's a lot of interesting things developing within that space.
I would invest it into Scottish American because it's trading on a discount like many investment trusts at the moment. So you're getting a portfolio of fantastic global growth companies paying dividends, and you're getting it at a reduced price. So I would go straight into Saints.
And the last time we spoke, earlier this year, we talked about Nvidia. Nvidia is obviously, you know, a major player in the global market. It was big holding in the fund. Is it still a big holding in the fund? Still one of the biggest?
So in absolute terms, the weighting probably has not changed really. So it's just less than 10% holding. But what has changed though is the composition of the market in itself, with weighting in Nvidia, have evolved quite dramatically. So I think maybe this time last year, Nvidia would be a much smaller part of the index. But if you look at the Nvidia's weighting within the market today, is probably close to 5%. So what it means is, as a long-only active manager, we're trying to do a lot better than a passive tracker or maybe the market in itself. So at the moment, our active weights, so the difference between our absolute weight versus the index weight, is quite small. So so in terms of the ranking of that position size, is now probably sitting in our 5th or 6th position. So in terms of the potential outperformance or underperformance from Nvidia, is going to be a lot less material in terms of how we're going to perform in the near future. So what is very important for us is then we need to move on. So while we still like Nvidia, we still think Nvidia can do well, not as well as what they have done in the last 2 years, but then we need to constantly look for new ideas, which is some of the names I just talked about, like, for example, like Flutter, which is a very small position in the index because it's a smaller company versus Nvidia. But then at the same time, we probably only have about maybe 5% position in Flutter, but just because it's a very small part of the index, so we would have a very similar active weight in Flutter to Nvidia, which might surprise some people. Like you think, oh yeah, so Nvidia is all about Nvidia, but it's not the case, because now you have other companies that would equally take up certain positions.
And there, actually, when I was looking through the list of the biggest companies in the fund, you know, the top kind of 5 and things, there were some names in there that would not be familiar to UK investors in the same way that, you know, Nvidia or Meta are. What are some of those companies in those, you know, the big positions that you hold, and what do they do? What makes them attractive?
So within the fund, in some of the biggest position that we like, one of those areas is biologics equipment companies. So Sartorius and Danaher, so 2 companies combined. So these 2 companies combined would make up just short of 10% position in the fund in itself. And if you look at the share price of these companies, they have not done that well, because there's been a bit of destocking issues on the back of the COVID vaccine drugs, and there's a lot of other maybe funding issue for biotech company to develop new drugs, because the interest rate has been very high. But what we do like about this area in biologics in particular is that, like, over time we would expect us to have exposure to personalized drugs, right? Because that's how the COVID vaccine was made. That's why it was so successful at the time. And I think at the same time, with AI development coming in today, generative AI capability is going to accelerate new drugs development. So then if you look at the drugs that's under development today, which not yet been approved, majority of them would be in biologics rather than chemically based drugs. So that over time you would expect the success rate of biologics would be similar to chemically made drugs, but then the proportion is a lot higher. So then once the drug is being approved, then you would expect that they would need to either use Danaher's or Sartorius equipment to manufacture those drugs. And I think the last point I would make on this, which is related to Trump, is there's this act called Biosecure Act in the US. It's basically to secure the development of drugs. So then they want to make sure, like any pharmaceutical companies or biotech company, in order for them to get approval for the drugs, they would need to have the manufacturing process approved at the same time. And of course, then they would probably want to filter out if you are going to use some Chinese equipment to manufacture the drugs, because they want to protect that. So this is part of the Biosecure Act in the US that I think Trump would be quite favorable about.
And outside of the US, what are the stocks there that you're looking at that you think look particularly interesting?
I think outside of the US is a bit more tricky, just because some of the companies that are probably exposed to multiple places. For example, like we have a small exposure to a luxury company called Moncler, and obviously for us, I mean, we think the company is very high quality. It's been around for years. It's actually doing quite well. But then when you look at the composition of the business, it is to have a sizable exposure to Chinese luxury consumer spending, right? And at the moment, of course, there's a lot of uncertainty in terms of the economies in China, about maybe the real estate crisis. There's a lot of things going on within that. So while the company over the medium term, or including other luxury brands like LVMH or some others, would be looking quite attractive in valuation terms, but at the moment they're still going through this journey of not having a very clear outlook of when they're going to start to grow again. So that's something that we are tracking or monitoring. And of course, I mean, for us, sometimes it's very difficult to time the entry point, right? Like, of course, if we have a crystal ball, that maybe is easier. But if you don't have that, then sometimes you just have to maybe take a small position, try to follow the story or monitor the development very closely. And at some point, if you think there's going to be a likelihood of the issues going to be resolved, then you can size up the position quite quickly. I think that's what we have done historically. That's what we did with the digital transformations before the pandemic started. And then by the time pandemic started, we were able to scale that out. And then similarly for the likes of Nvidia or some AI names that we didn't foresee ChatGPT is going to arrive. But then by the time it started to take shape, that we were able to scale up those opportunities quite quickly, I think. So this is one of those areas that at the moment is not very interesting, is probably not deliver any value in terms of performance. But then over time, yeah, we do expect that to take place.
Just waiting for that catalyst in the luxury market. And just before we finish, another stock that you hold that you said about obviously the costs of AI for some of the companies that are doing some of this work with generative AI versus the picks and shovels element. Where do you put Meta on that line, on that spectrum?
Yeah, so out of all the AI applications names, we like Meta the most. The reason being is that a lot of spending that Meta have made is going to be internally used. So which is very different to the likes of, let's say, Microsoft, who is spending a lot of money on Nvidia GPU to develop Office 365 Copilot, which is a new applications on top of Office 365. And if you look at Alphabet, is spending a lot of money in order to develop a competing product to ChatGPT, which is called Google Gemini, right? So this is a new market, and it's not proven that, let's say, Google Gemini would maintain a 90% market share in a few years' time versus what it has achieved so far, right? So it's basically developing some sort of product in order to protect the kind of ecosystem. But if you think about what Meta does, is all about optimizing the data that they have on us, so that they can deliver the advert to us in a more effective manner. So one thing that we are expecting, that we started to see already, is personalized advertisement. So if you think about historically, yeah, we would see an advertisement that's probably catered for, I don't know, 100,000, if not 500,000 people, which would be quite tailored already within your age cohort, or where you live, your maybe work profession, or what your friends or family like within the social media space. But then over time, because of the capability of generative AI, like we could be seeing personal advertisement, which is very unique to us, with a bit of just modification. And of course, like from a consumer perspective, we started to see something that's speaking to us. The conversion rate is going to be a lot higher than we're seeing something a bit more generic. So this is what generative AI is going to change that completely. And then secondly, within the Meta ecosystem, they also owned WhatsApp, as we all know. There's a lot of people using it every day. And what they've never really made money on the back of WhatsApp, but what's coming or started to come is they have developed some AI capability for businesses to deal to and interact with consumers. So of course, WhatsApp being a cross-platform communication tool, so that it doesn't matter whether you use an Apple's smartphone or Android smartphone, like WhatsApp would be used for by most people in the developed world. And at the same time, businesses find that actually this is a good way to communicate with people. And then, of course, you can't actually speak to everyone, right? If you order something from Nike and then you try to speak to the customer service, sometimes it's very difficult. So you want to have some sort of automation. So what Meta is working on is to develop some sort of AI chatbot that will be available to businesses that could deal with a lot of queries from consumers. So this would be our go-to kind of communication tool to speak to different companies. And of course, if they can come up with such a tool with the generative AI capabilities, they're going to save companies a lot of money, right? Then you don't need to have a call center, or you don't need to hire as many people in the customer service department. So then Meta will be able to charge businesses to do that sort of function. So that is all very that's quite achievable from our perspective. It's not something like you need to create a demand out of nowhere, and at the same time it's like optimizing the data they already have. And the other thing which I think people forget is, if you then think about the one single company in the world that have the most data on consumers, is Meta. And AI is all about matter, right? Sorry, AI is all about data. It's about training on data, and then we have given them.
We've given them all
our data. Yeah. So that is very invaluable on the back of this training.
Yeah. Okay, Stephen, that's all we've got time for. Thank you very much for joining us, and thank you very much for watching the Investing Show. Join us next time. Goodbye.